These are businesses which we think AI will be able to accelerate the rate of growth rather than act as a risk. And while over the longer term, we don't know exactly how industries are going to develop, in the shorter term, all the evidence suggests that these businesses are actually seeing an acceleration in demand, and they're being able to develop products that are attractive for customers and, importantly, to charge more for those value-added services. Well, ironically enough, we're actually really excited about the AI potential of businesses like RELX, Experian, Softcat that we own within Dunedin. These are businesses which we think AI will be able to accelerate the rate of growth rather than act as a risk. And while over the longer term, we don't know exactly how industries are going to develop, in the shorter term, all the evidence suggests that these businesses are actually seeing an acceleration in demand, and they're being able to develop products that are attractive for customers and, importantly, to charge more for those value-added services. RELX announced acceleration in growth. Experian announced recently again good, strong growth rates. We'll see Softcat announcing its results next week, but I expect that a business that is looking to help UK corporates develop and manage their technology needs is only going to see greater demand for its services and products going forward. All of these businesses have strong balance sheets. In Experian's case and RELX's case, they've both announced substantial stock buybacks to go alongside what are currently depressed valuations. And so from here, we see accelerating growth, very attractive valuations, and putting those two things together, potentially very attractive total return for us to take advantage of within the portfolio. Now, we've done an awful lot of work on this space, and we certainly don't come into it lightly. We certainly recognize that there's significant changes in a number of these industries, but that's been the case for a number of years. And while the stock market has chosen to really focus on this since the start of 2026, we've been considering this in our analysis for many years. And that gives us the confidence both to retain and increase our positions in a number of these companies. On REITs, we're actually pretty optimistic. So we have two significant positions in the real estate sector within the portfolio. The first is London Metric, and the second is Sirius Real Estate, both operating in different end markets, but I think have similar characteristics. First of all, they're looking to invest capital in higher yielding sectors. Secondly, they're also extremely active in terms of their capital allocation. If you think about the REITs that were dominant 20 years ago, Land Securities and British Land, today their market caps are a fraction of what they were back then. They haven't been able to evolve with the times. That ability to allocate capital to the sectors that they see having rental growth potential, constrained supply, attractive rates of demand has consistently marked out London Metric and its management team as one of the leaders in the space. They pay out an attractive dividend, well over 6% yield. And in the case of Sirius Real Estate, they're very focused on value-added opportunities within the industrial space, big portfolio of assets in Germany where yields are high, and increasingly looking to expand their investments within the UK. And so both of those are good examples of high yielding companies adding value through asset management, acquisitions and disposals, and to some extent development, but also able to generate good underlying earnings and cash flow and dividend growth as well. And so we're quite optimistic about those prospects. Clearly at the moment, there's a little bit more uncertainty about the path of interest rates. But if we do see those lower, and if we do work our way through the likely inflationary near-term impacts of the Iranian situation, then we would expect again that the REIT sector might be a beneficiary of lower rates over the medium term. So the defense sector is a complicated sector for investors. When Dunedin put in place its sustainability criteria back in 2021, defense represented around 1% of the FTSE All-Share in terms of its index weighting. Today, that's over 8%. So it's become a much more significant presence within the consideration of investors. I think it's right, though, that investors are cautious and investigative in terms of how they consider that. It's quite often the case that when a sector does very well, investors look to try to invest in it. We look to move the problems out of the way to enable our ability to take advantage of the opportunities, or at least the opportunities we think that sit in that space. We are considering how we can be more flexible in terms of our consideration around the inclusion of defence assets within the portfolio. But it is important to remember that a number of the significant companies within that space have had major controversies within relatively recent periods around bribery, corruption, and weapons finding themselves in the hands of the wrong types of people, whether that's Rolls-Royce or BAE Systems. These businesses have also tended to be cyclical, operating in their own cycle of government defence budgets, and they also have tended to rely heavily on particular platforms, lots of contract accounting, and complexity that sits within that. So there are a number of things, as with any company, that you need to think about in terms of the business model. There are, I think, legitimate sustainability concerns that need to be met. That being said, we don't think it's right to exclude companies from our consideration that are making small components that go into overall larger defensive platforms. A business like Melrose, which supplies the cockpits or engine components or parts of the fuselage for the F-35, we don't think that that should necessarily be excluded from Dunedin's purview from our sustainability criteria. And that's the type of business that we would potentially like to be able to invest in. And so we're thinking about how we can be more flexible in terms of our defence exclusions, but we're doing it in a thoughtful way and continuing to be very careful about the types of businesses we invest, the reputational risk that that carries, and ultimately the financial impact that that has on our portfolio. Well, the US-Iran conflict is just another geopolitical development in a series of geopolitical developments that we've seen over the last decade. And I think it's really important that from a portfolio construction perspective, from an investment philosophy perspective, that whatever we do is able to ride through these types of events. We can go back to Brexit, COVID, the Ukraine war. You know, we've seen an increasing number of these types of events. And I think it's really important that the companies we have within the portfolio going into this type of situation are in good shape. And because we focus on those very high quality companies that have strong, robust business models that aren't reliant on the economic cycle, that do have pricing power, that have strong cash generation, that do have very strong balance sheets and have diverse business opportunities, that they should be in a position to be able to manage through whatever is thrown at them as a result of this conflict. Generally speaking, we tend to do relatively well in periods of uncertainty and market concern. When we look back at some of these events of the past, the challenge for Dunedin's portfolio has been the risk of higher inflation and rising real interest rates. And with the impact that we've seen from the conflict on oil and gas prices, that's very much something for us to be focused on. We do have exposure to things like Total and GTT, which give us some degree of hedge to that. But we, on the other hand, also have to recognize that while this has the potential to be inflationary, it also has the potential to be significantly negative in terms of economic growth and the overall cycle. And that's the side where we see Dunedin's inherent resilience coming through. At the moment, the area which we're thinking about in terms of impact is more about our domestic UK exposure. We've seen UK bond yields rise significantly, the expectation being that the Bank of England is going to have to reverse its potential cuts to interest rates as a result of rising oil and gas prices, and we will have to see how that plays out. So our exposures in things like house builders, like Taylor Wimpey, or Genuit in terms of building materials, have underperformed during this period. But we have also seen, a lot of resilience from businesses such as RELX, Experian, Softcat, National Grid, and businesses like Total, perhaps more predictably, that have performed extremely strongly. So we do think we're well positioned going into a more difficult market from a cyclical perspective. We have to keep our eye on the inflationary impulses and the impact that that could have. But overall, we really want to have a portfolio of companies that we're relaxed and comfortable about investing for the long term, and where whatever happens from a geopolitical perspective, we're not thrown off course in terms of our overall investment approach. Thank you very much for watching. For more information, please visit our website. Thank you.